presentation contains current opinions of Moe's Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation.
Welcome to the Compak Market Wrap Weekly Update. My name is Javaid Ansari, Executive Vice President at Compak Asset Management, and this is your update on April 10th, 2024. Just wanted to first say thank you for everyone for a great quarter. Got some great feedback from all of our Market Wrap listeners. If you have any comments or questions that you would like us to answer on the YouTube or on the weekly podcast, just feel free to email us directly at invest@compak.com. We really do enjoy hearing all the comments and just kind of understanding what are some additional topics that our Market Wrap listeners would like us to explore here on the YouTube series as well as on the weekly edition of Market Wrap. But as always, if you'd like to subscribe to our communications, just go to compak.com/media, provide your email address, and we'll go ahead and get these out to you on a weekly basis. We are recording on Wednesday today. I was traveling a little bit earlier. Mo's out of the office this week. He will be back in the office on Tuesday next week, so we'll have a full update for you then. But actually turned out serendipitous that we actually are presenting the YouTube on Wednesday because we actually had pretty important piece of data come out regarding the markets and the particularly regarding the CPI number. So I'll dive into that a little bit deeper here on the YouTube today, and of course dive in as deeper as we always do on the weekly edition of Market Wrap's podcast. But once again, please go to compak.com/media to subscribe to the Compak Communications. S&P last week was down just a little bit. First kind of consolidation we've seen so far this year. Employment number came out on Friday, was still looking very strong. So economically, everything's looking great. And I think that actually fed into the CPI number that we saw today. That came in a little bit hotter than expected. And we'll get into exactly why that was. But you look at some other sectors, such as the Dow was down 2.23, Russell was down 2.86. Once again, I think that was due to, we'll talk a little bit about interest rates continuing to rise. We're still above that 200-day moving average. And as long as interest rates are rising and we're seeing this kind of inflationary stickiness, I think small caps are still going to be in a tough place. We like the valuations on small caps. We think they could particularly outperform, but we really have to set up the right conditions and really lower interest rates is what's necessary in order for those small caps to really start to outperform the broader market. And then you did see still growth, still outperform relative to value. Unfortunately, international stocks have just continued to lag, not only for last week, but you so far look at this year, emerging markets were only up 2.7% for the year. EFA, which includes a lot more of Japan and Europe, only up 4.5. Pales in comparison, beating the Dow and the Russell, but still the S&P, which is primarily still driven by the Magnificent Seven stocks. It's turned into a little bit more of a Magnificent Five with Apple and Tesla being down this year. NVIDIA really continuing to lead the way as long as Meta to the upside of as far as the Magnificent Seven. But we have seen a little bit more broadening out of the overall S&P 500 over the last month or so. So that's very positive. Hopefully that continues here going forward over the next couple of months. But I think the overall direction of the market is still going to be tied to these CPI numbers. And we got some of that additional data today. You saw last week, energy's been on a tear just over the last week or so, has been up another 4%. We've seen oil prices continue to edge higher, and I think as long as that's also happening, you can see now we're at $86 a barrel. We started the year at $72 a barrel. So we have, I think it's a combination of two things. One, you have supply being limited by OPEC. You have the Red Sea kind of conflicts, Middle East still, a lot of tensions there. So that was a big exporter of oil, and limiting of those supplies is going to push up price. But I think there's also that demand piece as well. U.S. economy is doing very well. Europe's, continuing to mutter along, but in a positive direction. China now has started to hint that they're going to start to stimulate their economy a little bit, and if they start to have a pick up in growth as well, they are a huge consumer of oil, and so as long as that oil piece continues to rise higher, and we see these barrel prices go higher, I think that's just one of the additional pieces that is just continuing to feed into this sticky inflationary type of environment. So it's something to watch. I think you once again can take advantage of these higher interest rates by beginning to roll. If you have a lot of cash, 100% in cash. I see a lot of clients that have just gone all to cash. They bailed out of the market in 22 and 23. Bonds and stocks were not doing very well. They went into cash. They're getting 5%. That's great. But now is the time to really kind of start to roll a little bit of that cash out, at least into some longer term fixed income, while you're seeing these higher interest rates, particularly on the 10-year, I think hit 4.5% today. So you're looking at other corporate bonds and those type of entities getting maybe 5.5%, maybe even closer to 6% in some investment grade corporate bonds going out just a couple of years. So great yields that you want to try to capture, because a lot of those rates of returns are exactly what are being modeled into your financial plan. And so if you can meet your returns of your financial plan by just investing in fixed income, let's just do it. Of course, we want to still have some growth in there to get some additional growth over inflation, et cetera. But it's a great time, I think, to be looking at fixed income in general. And because of that, we've seen bond prices actually came down last week. You see AGG was down 1%. Corporates were down 1.81. What I like overall, though, is I always am comparing high yield to the overall kind of more investment grade type of bonds. As long as high yield is continuing to outperform, and that's what we've seen so far this year, high yield's up 1%. Overall bonds have been down almost 2% this year as we've seen a rise in interest rates. You can see here we started the year at 3.88, and at the end of last week we're at 4.4, and we spiked higher today to around 4.5 today. And so I think it's really interesting that as long as high yield, this is what we saw back in September and October of last year. We saw a rise in interest rates all the way up to 5% on the U.S. 10-year Treasury. That caused the stock market to sell off almost 15% last year. But during that entire sell-off, high yield, which is typically one of the more cyclical fixed income markets, held in there really well relative to bonds. And that's so far what we're seeing. You can see it even here, just over the quarter. I know we just started here at the beginning of April, but if you some of the things we're monitoring on the investment committee here at Compak is this relative return of high yield to AGG and investment grade bonds. As long as high yield is holding up, and that's even the case today, with a spike in interest rates, I think a lot of these down moves that we'll see with these, kind of sticky inflation numbers are somewhat temporary and can be very good buying opportunities to be adding to some more equities, particularly if you're a lot of cash. If you're over allocated cash, you want to take advantage of these higher interest rates, but also as we see maybe a little bit deeper correction, hasn't been a big correction in the S&P today, but if we see a bigger correction, maybe down to 5,000 on the S&P, that might be a good time to be adding some more risk to your portfolio. And once again, that was slightly hot March CPI number came in today. Core was 3.8%, overall is 3.5%. And what you can just see here overall, things have just kind of really bottomed out here and have just kind of trended sideways. Core is still coming down a little bit, and that has to do with shelter prices are still coming down. What's still driving this hotter CPI, though, is really car insurance. I mean, you wouldn't think that would be a big piece, but if you go and renew your car insurance, I think you're going to be in for a little bit of a surprise as we're seeing premiums going up almost 10, 15, 20% when it comes to those prices on insurance. And I think that's a combination of a lot of things. I think this is still one of the last pieces of CPI that really kind of feeds through into the economy. We saw used car sales go up a lot last year. New car sales were up with all the supply chain disruptions of COVID and the pandemic. And so really, as you move down the chain and look at repair sales, repair costs and those type of things, those have gone up. And then the final thing is then insuring for those repairs, which is the insurance costs. And so that's continuing to go up. Hopefully that begins to come down over time. Looking at the services, that is kind of really flattened out when we look at CPI in terms of services and people providing those, not manufacturing, you have manufacturing and services, but services CPI seems to be a little sticky. And I'm just still not too sure about shelter. I know shelter is kind of moderating and coming down, but we all know if we look at asset prices, you look at that Zillow price today, those prices just continue to go higher and higher due to the lack of supply of new housing. And so I'm still kind of concerned. I'm not expecting any sort of major peaks in CPI like we saw here, in 2022 up to that almost 9%. But, if we kind of just go sideways to here or maybe even a little bit higher, and we're seeing that a little bit overall, overall CPI can be driven from more of that food and oil as well. And we just talked about oil prices going up. It's going to make it really difficult for the Fed to really look to curtail any sort of or start to do any sort of Fed cuts. And that's exactly what we saw with the expectations today. The Fed's cuts got pushed out a couple of weeks, so a couple of months versus maybe starting in June. Maybe we're looking more at September or even later. But I think that's all. We'll see those projections change so much from day to day. But this CPI number, we'll get the PCE at the end of this month, and then of course April CPI and even May. The next time the Fed has their meeting will be in May, and the CPI actually comes out on the day of the Fed meeting. These next three CPI numbers are really going to tell the tale of, I think, what is the interest rate trajectory going forward, at least on the short end of the curve. I want to caveat, though, that and say overall things are looking really healthy. We had the unemployment report, our employment report last week was looking really strong. That's why we're seeing a little bit of inflation. A little bit of inflation, given the amount of debt and everything else we have going on, isn't the worst thing. We don't want to get out of control. We don't want to continue to double down on that debt because as interest rates go higher, that debt cost becomes much more cost prohibitive for the federal government. But I think, in the end, this is kind of one of those things where we'll kind of take it. I'm long-term do believe we're in more of a deflationary type of environment as we're seeing the longer secular trends such as the baby boomers as they get older, not as kind of vigorous in terms of spending and injecting a lot of activity into the economy. I think that's going to just, and as we see overall population growth kind of top out and continue to come down, particularly in developed markets, which are the biggest consumers out there, I think that is overall pretty deflationary over a period of time. But we're still just kind of working through all of those excess liquidity that was input into the economy with the pandemic. And so at least for the short run, I think we just got to be kind of a little bit cautious when it comes to interest rates. Don't want to get too aggressive. I know everyone's talking about AI and stocks, but as long as we kind of still have this inflationary pressure here and the potential for interest rates to move higher, that's going to continue to be a pretty big, strong headwind for the markets, or eventually kind of leads to that eventual drawdown once people say, okay, this is kind of here to stay. We're not really going to price in seeing those big rate cuts as we have in the past. Economic news, as we talked about, the CPI number came out today. We have PPI tomorrow, and then import prices. But we've really dived into CPI numbers today, so that was the big news. As we talked about, employment was very positive last week. So once again, if you'd like to get more of this communications delivered directly to your inbox, just go to compak.com/media. Forward the link and subscribe, of course, to the YouTube, to your friends. We really try to be a signal through all the noise here that you get from maybe more of the mass media. Really try to let the markets determine exactly kind of what's going on and interpreting those markets to really give us the best feel of how exactly the economy is doing versus really weighing on everyone's opinions. And so that's why we really love following markets so much here at Compak, and of course managing our clients' assets, not only with their portfolios, but through financial planning and tax planning. If you'd like to learn more about Compak services, please just give us a call, 800-388-9700, or email us at invest@compak.com. So once again, that is the weekly update for April 10th, 2024. Mo will be back with those technicals next week on Tuesday, so stay tuned. Until then, good trading.
This This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.